and welcome to the StoneX Grains and Oilseeds podcast. I'm your host, Craig Turner. I am a grain broker here with StoneX in Chicago. It is WASDE Day. We're just going to jump right into it here. If you have any questions for me, all my contact information is in the show notes. And you can also go to www.grainsandoilseeds.com to register for my webinar series, or go to stonex.com/Craig-Turner, again, in the show notes, and you can go ahead and look at our services and products here. Okay, let's get into it here. I've got a couple of things I just want to talk about. The WASDE came out about 45, 50 minutes ago. Markets are generally down. These corn is about, let's bring this up. These corn, there we go. Kind of doing all this in real time here. These corn, okay, right around $4. We've got our 20-day moving average at $3.99. We got our 50-day moving average right here at about 405. You can kind of see that's where we are. After the report came out, I mean, this is where we were pre-report. We're about 405. Report came down, and we've been hanging around $4 here since. Why? Now let's talk a little bit about what happened. So listen, the WASDE basically kept acres the same, but we can see here they did increase the yield 0.5. But even though production went up a little bit, you can see the beginning stocks went down, so which means last year's ending stocks went down. And then we're also seeing, let's see, any other changes on the demand side? Not so much. So listen, we're right about 2 billion carry out again. No big deal. No big deal in terms of, like, with the changing ending stocks big either way. For me, what this means is that the corn ending stocks are adequate. We're not tight. We're not burdensome. I don't think we're burdensome, but we back in 5-10 years ago, 2 billion carryout to me meant harvest lows on the futures around 330, 335. I mean, that's around $4 today if you add on 20% inflation. So where we're trading right now, if we're going to talk about, if we all believe that 20% inflation is real post-COVID, this area is, I think, kind of appropriate here. So let's just see where, I'm going to go back and take a look here. Where were we 5 to 10 years ago? I'm going to go into, this is our DT Pro or StoneX Trader application that I'm using here right now. But I mean, you can see 2019. Here's our 330 line. I'm going to just use our 330 line so it's easier for you guys to see. But this is our 330 line. So in years where we had 2 billion carryouts, I mean, these would be the monthly lows on corn. Yeah, you add 20%. That new line is, probably right around here. 330 plus 20% is 395. I mean, we're right there. We're not that far off. So this makes sense to me where we are on the pricing side of the corn market. For as far as things to come on corn and where we see things going, I would think that once we get the harvest pressure of corn, and I can see corn, go back to the daily chart. I mean, I can see corn coming back down here and maybe testing this area between 385 and 390, especially if there's just a ton of corn that needs to be priced, which there is. Sounds like there's a lot of good crop out there. You can see the MACD coming down. You can see the RSI going below 50. So I wouldn't be shocked here over the next couple of weeks if we went here, this 390 area. But if we should rally, I don't see any reason why we go above 414 or 415 between now and the end of the month. And likelihood is we kind of make a double bottom here with harvest. You never know with exports picking up or guys get in the field and things don't look as good. But that's just kind of odds are. If we're playing the odds, that's where we think things are. Now, as far as, we looked at that monthly chart going back 10 years, back 15, 16, 17, and 18, ending stocks were about 15% stock to usage. This is what this chart is showing us here, the United States carry out stock to usage as a percentage wise. We're getting back there. for 2024. So, we do expect prices to be in the low range. Now, going forward, let's take a look at major exporters. Major exporters aren't as tight as the United States, are tighter than where the United States currently is. Back in 15, 16, 17, 18, 19, major exporters were also pretty burdensome. But that is not the case here. It looks like the United States is really the country that has all the corn. So we're going to be the world's residual supplier of corn here. And then you got to ask yourself, well, what's the rest of the world looking like? What are the likelihood of the United States getting some export demand this year, maybe, or an increase in export demand? Well, this chart I think is very interesting. This is when you take the United States out of the major corn exporters, and that just means we're going to be Argentina, Brazil, South America, South Africa, Ukraine, and Russia. We're at 3%. This is the tightest the major corn exporters have been without the U.S. since the ethanol era, right? So what that means to me is, here's our, probably too small on the screen for you guys to see. Let me just go back to the WASDE. This number here, this exports number right here, I think this exports number has potential to increase. And if it does, that means we can see the ending stocks come down and be below 2 billion. Now, it's not going to happen now, but it certainly can happen. And especially with where with prices below, cost of production, they'll even be talking about, are we going to have, enough acres for next year? Maybe we'll be on the, here we were 88 million acres just back in 2023. I know we had late planting, but when we've had years where we've been below cost of production, we've been around 88 million acres. I mean, 88 million acres and a 173 yield. With 78 harvested, we had a production of 13.6 billion, right? This year we're going to be 15 billion. So if we see a little bit lower acres, a little bit lower yield, see an uptick in exports, I mean, all of a sudden corn can be at a 10% stock to usage again. And when you get 10% stock to usage in corn here, and we go to the monthly chart, I mean, that's how we get prices basically in this zone, right? This is where prices can be when we're below 10% stock to usage and we need to price ration. Honestly, if you add on 20% to this old price range, we're really talking like a 530, 520, and this is probably higher, like, I don't know, maybe 9. I kind of don't want to say it because you never want to get into the media cycle with saying stuff like that. But this is probably the new range here. So when I'm looking at corn and we're at $4, and if we get close to a 1.5 billion carryout, even if the market just thinks it's a possibility, I mean, in the old days where corn could go between 350 and 420 for most of its time, I think that new range is $4 to about 520, 525. So in my mind, the funds will probably start to get out of shorts here. People will start positioning themselves more long or at least neutral going forward. And I mean, yeah, I mean, just take a here. So I'm going to try to blow this up a little bit for everyone. If I take a look at corn here this is next year, planting for next spring, if we're at 90 million acres again and a 182 yield, we basically use as much as we produce, right? And we're around these prices, but with a normal range. I mean, when we used to bottom out on harvest at 330 back in 2016 through 19, we could still go up to $4, even with a projected 2 billion carryout just on weather concerns, or 420. Now that range can be 4 to 520, 530. If we have 88 million acres and just the market, and we're below cost of production for a lot of land that's rented out there, and the market is even concerned about a a 178 yield or a 179. Look at this, we're at 10% stock to usage. So it doesn't take, and that's not even increasing exports, which, by the way, someone can make a very good argument that exports could increase just at being a 3% stock to usage of all major exporters taking out the U.S. So if you follow me in Turner's Take, or I guess in grains and oilseeds in the podcast and the newsletter, I'm starting to come out of shorts and looking at ways to get long. And I like in the near term, you can do futures, but when we're going out to July or D's 25, I like collars. I think it's a very interesting way to play this market. I can't put in specific trade recs on on a podcast or a video or anything in social media, but if you follow my newsletter or you talk to me personally, I certainly can. But I do like that idea of selling puts below cost of production to buy a call up top as either a price target or a reownership strategy. So it could either be a reownership strategy or act as a courage call. And I think there's very good reasons to do that for a hedger and a producer, also an end user. And honestly, if you're a spec trader and we think the corn market can move up here, you can use that idea too. So that's my big takeaway from the WASDE on the corn side. Let's take a look real quick. I'm going to scroll up to in the WASDE report to wheat, only just to say that nothing happened. So with the wheat market, here we go. Here's wheat. Uh, as you'll see, these two columns here on the right, they're exactly the same. None of these numbers have changed. And if we go look at wheat by class, we take a look at the difference between September and August. Just uh, through hardwood wheat all the way through durum. Not a single number in these last two rows has changed. So wheat's exactly the same. I don't know what the market was expecting. I'm seeing that if we take a look at, we're going to take a look at Chicago wheat here in a second. I'm going to take a look at Chicago wheat here, and you know, oh, I don't want the monthly chart. I want a daily chart. And we're going to come out of this. So we want a daily chart here for the wheat. And, this kind of, we haven't done a whole lot today. We're above the 50-day moving average and the 20-day moving average. And I'm not surprised. I think we've put in a multi-year low here for the wheat market. The reason being, might as well just get into that right now. If I go over to our graphs here, let's take a look at wheat real quick. Carry out stocks usage, I know it's high, and that's been keeping wheat in the lower pricing range. But if I scroll down here and we go to major wheat exports, we're at 13%. We're about as tight as we've been since 2007. And when I take a look at the other major exporters, Canada, we're going to be low this year, probably lower than we've been even after the drought year. Australia, stock to usage as low as it's been since 2007, actually lower. Kazakhstan, they're doing okay. They're going to have a little bit more of a surplus. Russia, getting very tight. You know what's interesting? So Russia is by far the biggest exporter and low cost provider. When they get below 10% stock to usage, this is when they start doing export bans. So that situation, could happen. Ukraine again has been able to, they're going to be projected to be tight by the end of the year. Also, look at the world wheat carryout. This is the long-lasting, ranging effects of the Ukraine war. It really is. The world cannot just get back into high supplies of wheat. The United States is really the last major player to have a big exporter. Here's Argentina, Australia, Canada, and the EU. When you combine those four countries, they're combined the lowest they've been since we've been keeping these records here. So the wheat market also is something interesting, and I have been looking for ways to get long wheat. Once we have the harvest pressure of corn and soybeans, there's going to be nothing really to keep wheat down in terms of harvest. We've already harvested all the winter wheat. We're more than halfway. I think we're 85% done in U.S. spring wheat. You throw in Canada, they're probably 50% done now. The northern hemisphere is pretty much wrapping up their wheat harvest, done winter, and across the northern hemisphere, spring wheat is wrapping up, and it would be allowed to rally here, especially once the pricing pressures of corn and soybeans are done by the end of September and maybe early October. So I can find some pretty after just looking at this report again, the WASDE, I can find reasons to be wanting to rather be long wheat than anything else. Now, I will say this: there is one problem that we're kind of just trying to reconcile here is how we feel about soybeans. Let's see Okay, so here's our soybeans. And what did the USDA do? Didn't change anything on the production side. Beginning stocks came down 5 million. Production came down just a snag. I can't even, so small I can't even see it on here. So ending stocks are 550. It's there's no real change in any of this. And then if we take a look at, let's see what we have here for our stock to usage for soybeans. Brazil's going to be at about 20%, not a big deal. Argentina, they're going to be up at 30%. So they're both adding to supply. Oh, this is Argentina and Brazil, excuse me. They're both adding to supply. I mean, major carryout is going up. So this is this is Argentina, Brazil, and the United States. Those are by far the three major exporters. It's Argentina meal, U.S. meal. Yeah, I mean, here's U.S. carryout. Just not looking good for beans. We need some kind of issue. Now, one thing I will say is that if what could get beans going, um, let's here we go. I'll show you what could actually potentially get beans going. We're going to go over here to soybean production. And when I take a look at soybean production by country, this is Brazil, right? We're projected for what, 169 million metric tons. United States, 125 million metric tons. You can see Argentina and China, right? So that's just, so you can just see how important Brazil is. But United States uses a lot of its soybeans, much more at a greater than percentage than Brazil does, which means Brazil is just a massive exporter. So look at the soybean exports by country. I mean, Brazil is exporting about 105 million metric tons. The United States is going to be about half that. So if Brazil, which is very dry right now, has production issues, soybeans really could coil up and go. And anyone who's been, around the soybean market for any length of time can see how fast soybeans can go. So this weather market that could be developing in Brazil is actually a big one, right? It's very important. And if I'm gonna just go back to a monthly chart here. Here's a monthly chart of soybeans. And when we are in a well-supplied market, we're at here's, and again, this is 2016 through 19. We had low prices, the tariff wars, uh, swine fever for hogs, and we were trading in a normal market somewhere between, let's say, 8.60 to almost $11. You add on 20% inflation, that 8.60 gets closer to $10, and this $11, it's closer to 13. 11 bucks times 1.2, 13.20. So, if we get weather issues, if we get an uptick in demand, if China starts coming and buying, this old range where we would expect it just during a normal year of harvest lows to weather premium and, planting and demand and summer weather premium, whatever it may be. I mean, soybeans could go up to $12, $13 again just by using a normal range adjusted for inflation. So it looks pretty bearish right now, but even in these years where we were low, and I got to say, probably the worst of it was this, we were, I mean, we had the results of the tariffs and the tariffs and the swine flu. I mean, we barely got to $10 again, right? Back then we had these 840s. This was a tough time for the soybean market. But even then, even if we were just at a six, I mean, I want to say back then we were 800 on the carryout. We were projecting at one point and just getting very, very bearish beans where the high, no matter what, was going to be 10. But even in the most bearish scenarios, then, if the high can only be 10 in that period and you add on 20%, then the potential high is 12 bucks, right? So I don't know. I'm not bullish beans at the moment, but I do what price ranges can happen, and you get any kind of reason for the market to wanting to be bullish. Um, you know, let's take a look what that would mean. Like here is where the WASDE would be, 550. I don't think anyone thinks we're going to have 87 million acres of beans again. Actually, last time we were down this low, when we did have those very low soybean prices, we tended to be closer to 83 million acres. So let's just say it's 83 million acres and a 52 yield. We're at a 400 million carryout, and we got a stock to usage of 9%. To me, that's 11 or $12 beans. If we are dry and have weather issues, and the market thinks we could have a 50 yield with 83 million acres, and all of a sudden we're beans in the teens. So, I know things look not great right now, and I don't think things aren't going to recover this week or next week or probably this month. But the markets do gyrate. We do have highs and lows over the year. All is not lost because we have these low prices. And honestly, if it's I'm thinking soybeans are at about 960 is back in 2019, 18 prices is $8 soybeans. So in my mind, soybeans kind of like a 960 to $10 low. And then, a realistic, if we do get lower acres and some weather issues and a pickup in demand, there's no reason spring or summer highs, or maybe even a winter high, because of South America, couldn't be somewhere in this 12 to 13 range. So I think we need to position ourselves accordingly, especially if you have to sell a lot of soybeans here at harvest. So if you have any questions about how to do that, give me a call. My number is 312-706-7610. Got a lot of ideas how we can use that either through options or the futures market or a combination of both, or using collars, or selling put spreads and buying call spreads. There's a lot of ways to go about it, and depending on what your comfort level is with risk and margin and capital. But there's usually something for everyone depending on your risk tolerance and capital available. So I think that is going to do it for me today. I gotta, it's a WASDE day, and we're all busy around here. But if you have any questions, contact me. Happy to talk anytime. And thanks for listening, y'all, and watching. If you're watching this on YouTube, and talk to you all soon.
This material is conveyed as a solicitation for entering into a derivatives transaction. This material has been prepared by a Daniels trading broker who provides research, market commentary, and trade recommendations as part of his or her solicitation for accounts and solicitation for trades. Daniels Trading, its principals, brokers, and employees may trade in derivatives for their own accounts or for the accounts of others. Due to various factors such as risk tolerance, margin requirements, trading objectives, short-term versus long-term strategies, technical versus fundamental market analysis, and other factors, such trading may result in the initiation or liquidation of positions that are different from or contrary to the opinions and recommendations contained therein. Past performance is not necessarily indicative of future performance. The risk of loss in trading futures contracts or commodity options can be substantial, and therefore investors should understand the risks involved in taking leveraged positions and must assume responsibility for the risks associated with such investments and for their results. You should carefully consider whether such trading is suitable for you in light of your circumstances and financial resources. You should read the risk disclosure accessed at www.danielstrading.com. Daniels Trading is not affiliated with, nor does it endorse any trading system, newsletter, or similar service. Daniels Trading does not guarantee or verify any performance claims made by such systems or services.